Whereas it is pretty obvious by now that CBK has been hell-bent on cutting down rates. We have seen the MPC reducing the CBR rates. We have seen the Treasury bill auction for this week dropping down to a 7%. Remember, there's a point when we had at 14%, 12%, 10%, 9%, 8%. Now, the 91-day T-bill, the 3 months T-bill for this week has finally hit 7%. But that aside, we are aware that CBK reopened 3 Treasury bonds for the auction of September. We are also aware that one of these papers is actually going to be auctioned at a net coupon rate of 10.8%, and you shall be earning that 10.8% for 15 years. At the same time, we have yet another paper which is better, has a better coupon rate. This is 11.88%, and wait for it. If you take up that paper, you'll be earning the 11.88% for 12.5 years. Now, the video that I reviewed previously was a 22.2 years paper, which carries a net coupon rate of 12.7692%. Now, let me ask you, would you believe me if I told you that it is possible for you to invest in Treasury bonds now and have the potential of earning highs of 20%, 24%, 17%, 18% by actively trading in bond? As a matter of fact, if you had watched this video that I did demonstrate to you how you can sell off your high coupon papers, the 18% coupon rates, the 16% coupon rates, the high coupon papers that you're holding, and reinvest it in the low coupon papers and have the potential of earning more coupons or higher coupons than you are earning on that IFB that had 18%. That is called active bond trading. But don't you worry. I know you're going to tell me, Berlin, how do we do this? I'm going to tell you how to do it passively. But before that, please take a minute and press the subscribe button. Also, do give me a thumbs up if you think that this video is going to add some value to you. At the same time, kindly do leave me a comment in the comment section. Would you consider selling your high coupon bonds and taking the low coupon papers if it has the potential, or if you're guaranteed that it's going to pay you more, that you're going to grow your wealth much faster? I mean, if you are guaranteed that by doing so, you're going to improve or increase your coupons from, say, 150,000 shillings to 200,000 shillings, or to 180,000 shillings, from 150 to 180,000 shillings. Is it a decision you could make? Well, if it's something that you could make but you don't know how to do it, I would like to share with you how you can do it passively. What do I mean? The Capital Market Authority, CMA, has licensed a number of fund managers who operate collective investment schemes and have bond funds. If you have been in this channel for a while, you'll notice that I haven't talked much about bond funds. But today, my interest has been piqued by this specific bond fund, the Arvocap Almasi bond fund. So in this video, I would like us to have a look at this bond fund, see its potentials, compare investing in bonds directly, especially in this low interest regime, and investing in the bonds but through a bond fund. My name is Berlin. Please don't forget to subscribe. Now, a bond fund is a collective investment scheme. The Almasi Fund is a collective investment scheme whose underlying assets is Treasury bonds. It is licensed by the Capital Market Authority. It is regulated by the Capital Market Authority. It checks the first check boxes. It ticks the first check boxes, of what you need to look up when taking up an investment in a collective investment scheme, right? Now, the Almasi Bond Fund, it's a fixed income fund. I've told you the underlying assets is treasury bonds. Now, this bond or this fund, the fund manager, trades actively in the treasury bond market. What I mean by that is that they go to the secondary market and they source for prime bonds, and then they buy, they earn coupons, and they also sell the bonds so that they earn revenues by earning coupons from the bonds that they are holding. They buy cheap bonds and look for where to sell them at a premium. Okay, so they buy cheap and sell high. So by so doing so, they also earn revenues through capital gains. So how does this bond fund and investing directly in the treasury bonds compare? I would like us to run a quick comparison between investing in the Almasi fund and taking up the treasury bond. Now, the Almasi fund has a minimum capital of 100,000 shillings. The minimum investment amount is 100,000 shillings, while the treasury bond, the minimum amount is 50,000 shillings. So with 50K, you can go directly to CBK and take up your 10% coupon paper or the 12% coupon paper or whichever paper that CBK is floating. But if you want to join this bond fund, you need to be having 100,000 shillings. The top-ups is also the same. CBK in multiples of 50K, and the Almasi fund a minimum top-up of 100,000 shillings, right? Now, the management style. When you take up the Almasi fund, the fund manager will do the actual purchase of bond. Now, being a fund manager, it means that at any one time, they are always bidding more than 2 million. They have the ability to put up competitive bids. And because they have a good understanding of the market, they actively trade in the market. They have that experience. They know at what rate or what yield to bid at. Yeah. Now, if you are trading individually, like if I'm trading individually, I will have the trouble of choosing which bond to pick or which one to skip. I'll have the trouble of getting a broker to go into the market and source a buyer for my paper whenever I want to dispose it, or to get me a good deal when I want to buy a paper in the secondary market. So that is a difference. I manage my investment independently, and when I do the bond fund, I'll have somebody else taking the trouble of choosing the papers to buy and the papers to sell on my behalf. Another difference is in the fees. When you take up the bond fund, of course, the fund manager is going to work for you. So the fund manager is bound to charge you some fees. They have a management fee of 1%, they have an initial fee of 0.5%, and they have a performance fee of 20%. Now, that we don't have in the bonds. In the bonds, for as long as you're going to CBK directly, you're buying directly, there's no fees. However, if you'll be buying the bonds through a broker, then you'll be having the brokerage charges, which varies from one broker to another. Another key difference that we have is the income frequency. When you buy the bonds directly, when you're holding individual bonds, then you earn income semi-annually from each paper that you hold. So if you're holding maybe 6 papers with coupons being paid in the 12 months of the year, then you'll be having one income every month. But with the bond fund, the fund manager earns coupons from all the papers that they are holding. So it's possible that they literally earn coupons every week. It's possible that they literally earn coupons every month of the year, all right? They also earn income or realize income or revenues whenever they sell a paper at a premium. So if they're able to make a sale every week, then they literally have the capacity to earn capital gains literally every week. The opposite of that is also true. If they sell at a discount, then they make a loss, all right? Now, another key difference that we see is with the diversification. When you are investing as an individual, you can only take as much, okay? You might lack the limitation, especially if you lack sufficient capital. You are going in with 1 million and you're going in with, say, 300,000 shillings. Now, your 300,000 shillings can get you a maximum of 6 papers, assuming you're taking 50,000 shillings on each paper, yeah? However, if you go for the bond fund, your 300,000 shillings can get you a piece of pie in even 20 papers. For as long as the fund manager has bought a bond, you are a part owner of that bond. Okay, so we have diversification in the bond fund, something that we lack when you're taking up individual bonds. Another key difference that we have is reinvestment risk. Reinvestment risk is the risk that when your investment matures, you are going to reinvest that asset at a lower interest, or in the process of reinvesting it, you are likely to lose some value. Okay, for instance, in August, during the August auction, we had I think it was a 16% coupon paper which was maturing, or was it the 18% coupon that was maturing? We had a high coupon paper maturing, and we had a 12% IFBs on auction. So reinvestment risk is the risk that when your 18% coupon paper is maturing, the market rates will have dropped, so that when you are reinvesting the money that CBK is paying you, you are reinvesting it at a lower coupon rate at 12%. You are not in a position to continue earning the high coupons on 18%. So that is reinvestment risk. So individual bonds predisposes you to reinvestment risk. However, when you take up an investment in the bond fund, that reinvestment risk is diluted by virtue of the fact that the fund manager holds a portfolio, or a diversified portfolio of bonds, and they also earn revenues through coupons. So the reinvestment risk is a bit diluted in the bond fund. Okay, now another difference which comes as an advantage of the fund, of the bond fund, as opposed to taking up individual bonds, is liquidity. When you take up investments in the, when you take up the individual bonds, say for instance, you take up the 10% paper, the SDB, which has a net coupon rate of 10%, and 2 years down the line, or 3 years down, or even 5 years down the line, rates are higher, and you want to sell that paper, you're gonna have to sell it at a discount. However, if you are in the bond fund, and you want to access your money, you'll access the actual amount that you hold in the funds. Okay, and more often than not, you're expecting it to be higher than your initial investment if you don't withdraw, because this fund automatically reinvests your gains, and as such it compounds. Now that gives us another difference between the individual bonds and the bond fund. The individual bonds lack the element of compounding, let me say auto compounding. You, the individual investor, would have to take the trouble of choosing where to reinvest this, either taking up another bond, or buying shares, or doing an MMF, or buying property, depending on how much coupons you're earning, or whichever reinvestment that you're going to compound it. Yeah, you have to take the trouble of making that decision to reinvest. And woe unto you if you wanted to hold a portfolio in bonds specifically, and the rates are now done, you're going to have to reinvest it at a lower rate. Okay, however, if it is in the bond funds, the gains are automatically reinvested on your behalf. It compounds. It automatically compounds, because whatever income you have earned is going to be reinvested on your behalf, just like we have in the money market funds. Whatever income is credited to your account at the end of the month is automatically reinvested, so that you're in a position to earn more. Another key difference that we have between the treasury bonds or individual bonds and the bond fund is the maturity value. With the bond funds, we don't know the maturity value. Why? Because we don't know how much because we don't know how much the fund manager is going to make on our behalf. And remember, it is compounding. So I don't know 5 years from now if I had given them 1 million, how much will I be having? Will I be having 5 million? Will I be having 3 million? Or will I be having 2 million? I honestly don't know. However, with the Treasury bond, you know for a fact that if you give CBK 1 million now, 1 year later or 10 years later, you'll be receiving back exactly 1 million. So the maturity value is predetermined with the individual bonds, but with the fund manager or with the bond fund, it is not predetermined because we don't know how much exactly the bond manager would have made. Now, that gives us another difference. With the individual bonds, your earning is fixed. The coupon amount is fixed. If you're taking the SDB, and you give them 1 million, you know for a fact that every 6 months you'll be receiving 50,000 shillings because it's 10% of the 1 million. Okay. However, with the bond funds, it is not fixed. It depends on the performance of that fund. Yes, the coupons are fixed, but we don't know which fund, which bonds these guys are going to buy. We don't know how much of a discount they're going to sell so that they make a loss. We don't know how much of a premium they are going to sell so that they make some capital gains on our behalf. So the income for individual bonds is predetermined. It is fixed. However, the income for the bond fund, it is not fixed. Okay? So these are the key major differences between taking up investment in bonds, individual papers, vis-a-vis taking up investment in bonds, but through a fund manager in a collective investment scheme. Treasury bonds are still considered low-risk investments, except when it comes to liquidity and you want to sell it. Remember, a risk is the possibility of you losing money. Now, when you take up a bond at 10% or 8% or 7%, and you want to sell that paper when rates are higher, you're going to have to sell it at a discount. And that risk, that possibility of you not being able to get back your 1 million when you need it, that possibility that you're going to have to sell that bond or that paper at a discount is the risk, liquidity risk. Now, that is something that is well mitigated with the bond fund because it is a diversified portfolio. It's a diversified in different papers, and the income is a range of coupons, capital gains, and revaluation. Chances of you having to receive less is quite minimal, even though the fund is rated as a moderate risk fund. Now, I would like us to compare an investment in the fund as from last year and an investment in a treasury bond last year, the same time. However, a disclaimer, past performance is not an indicator of future performance. However, let's compare the returns that the fund manager has given us as from inception up to date. Remember, it's only 1 year in the market, and they are yet to update their performance for July on the website. So I'm going to compare July 2024 to June 2024, and then we see how that would compare to if in the event that you had taken up a treasury bond during the same period. Now, in July last year, they made a return of 2.35%. That is net of the initial fee and net of the management fee. In August last year, they made 2.4%. In September, they made 2.16%, all the way up to June this year now, where they made a return on investment of 1.9% during that month. Cumulatively, they made 28.96%. Now, remember, this is gross of performance fee. And according to their fact sheets, the performance fee is charged at 20% above the hurdle rate. And what is their hurdle rate? The hurdle rate is the yield for the 5-year treasury bond. We are going to assume an average yield of 10.75%, yeah? So our hurdle rate for this for the purpose of this video is going to be 10.75%. So that cements whatever we had said earlier, that the return on investment is not it cannot be predetermined. We cannot tell our future value or our maturity value at the point of exiting the fund. Unlike the bonds where we know how much we'll be receiving from CBK on maturity. Anyway, let me stop digressing. Cumulatively, they posted a return on investment of 28.96% as at June this year. Now, that is over a 1 year duration of time, yeah? But don't get excited still. Remember, this is gross of performance fee. What is their performance fee? Their performance fee is 20% above the hurdle rate. And what is their hurdle rate? Their hurdle rate is the yield for the 5-year Treasury bond in the Kenyan market. So we are going to assume a yield rate of 10.75%, meaning that the performance above the hurdle rate is 10.96% minus 10.75%, we have 18.21%. So they are going out of the 28.96%, they are going to charge us 3.64%, meaning that their net performance is 21.52% using this illustration. So if you had given them 1 million last year, by June of this year, you ought to have been having 1.2 million. So you see the 21% is better than the 18% last year. Now that rates are down, are low, one advantage of investing in bonds through a fund manager as opposed to investing in bonds directly is that you don't tie up your money at 10% for 22 years. You don't tie up your money at 12% for 22 years. You don't tie up your money at 11% for 15 years. You don't tie up your money at 10% for 12 years. You let somebody take the trouble of making those decisions on your behalf. And you know what? If they're not making gains, you can always withdraw your money. And you know what? If you feel like they're making these small returns, or if the return on investment that they're posting is less than 12% or is less than 10%, then you have the advantage of being able to withdraw their money and reassigning it to a different fund or to a different asset class or to a different asset altogether. Yeah. Otherwise, it's the bond fund, in my opinion, will be saving me the trouble of having to lock up my money at a low coupon rate over a longer duration of time. Okay, so please leave me a comment in the comment section. Do let me know, share with me, what do you think about this bond fund? Would you rather take up the bond fund now, and when rates becomes more favorable, you can now pump whatever amounts you have earned to the bonds, or would you rather go to the bonds directly? Remember though, that in addition to the risk that we have in investing in bonds, the fund manager has an additional risk of management risk. Management risk in the sense of making unsound investment decisions on your behalf. So that is an additional risk that the fund will predispose us to, as opposed to taking up individual bonds. But even at an individual level, you'll still have the risk of making unsound investment decisions as you invest in the bonds. So it's more or less the same, yeah? So what do you think? What do you think? But remember, I told you that past performance is not an indicator of future performance, number one. Number two, remember I told you that the bond fund is rated a moderate risk investment, and investment in Treasury bonds still remains a low risk investment. Okay, so what do you think about these two options? Would you rather take up the 10%, 12%, 11% coupon bonds, or would you rather make a stop in the bond fund, and when you have a better opportunity. You can then now take your money from the bond fund and take up the bonds. Please leave me a comment in the comment section. I'm curious to know what you think about this. And in the event that you haven't started your journey towards investing in the treasury bonds, I'm going to drop you a link in the comment section for DAO CSD so that you can open your DAO CSD account and buy your bonds directly from CBK. If you want to go through the bond fund, I will also drop you a link in the comment section so that you can invest in the bonds through the bond funds if you don't want to tie up your money for the 22 years, 12 years, or 11 years at those coupon rates. Otherwise, thank you so much for staying around. Thank you so much for joining in, and let's meet on the next video.